people are looking at silver with greater and greater interest because they're beginning to understand that gold is actually in a bull market. And even though we've got a sort of pause in the whole situation at the moment, and we don't know how long or how deep that pause is going to be.
Well, it should be another strong year for gold. I think 5,000 is kind of a, minimal target. Maybe more likely, if you're looking for round numbers, we should get $6,000 gold sometime in 2026. That would obviously go along with $100 silver. I think both of those are reasonable targets. But ultimately, both metals are going a lot higher because I do think that we're going to have a U.S. dollar and a sovereign debt crisis.
Market analyst Alasdair Macleod highlights mounting stress beneath the surface of the silver market, pointing to clear signs that physical availability is becoming increasingly constrained. He notes that recent spikes in silver lease rates, surging into unusually high territory, signal an urgent scramble by market participants to secure metal for delivery. While some supply pressure has been temporarily eased through leasing activity and the use of exchange-traded products, Macleod stresses that these mechanisms merely delay the problem rather than resolve it. Borrowing ETF shares to redeem physical silver effectively shifts shortages forward in time, creating a growing imbalance between paper claims and actual metal. According to Macleod, the core of the issue lies in accelerating industrial demand alongside tightening supply dynamics. Silver consumption continues to rise due to its critical role in photovoltaic production, defense technologies, and advanced manufacturing, while above-ground stocks are increasingly tied up and unavailable to the open market. He also draws attention to geopolitical risks, particularly China's evolving resource policies. As both a major silver producer and a nation already restricting certain strategic exports, China's actions introduce an added layer of uncertainty that could further limit global supply. With much of the vaulted silver in London and futures exchange warehouses effectively spoken for, Macleod argues that true market liquidity is far thinner than headline figures suggest. Macleod further emphasizes that stress is becoming visible through delivery demands on futures exchanges and disruptions in ETF markets, notably in regions such as India, where silver ETFs have been forced to suspend share creation due to a lack of available physical metal. He sees this as evidence of a growing disconnect between paper pricing mechanisms and real-world supply. As confidence in fiat currencies weakens and gold continues its broader bull market, silver demand is likely to intensify as investors seek a more accessible alternative. In Macleod's view, rising prices may not unlock significant new supply, as both industrial users and investors are increasingly incentivized to hold rather than sell, reinforcing a structural shortage that remains unresolved. Now, we present the clips from Alasdair's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
We have seen backwardations between the spot price in London and the futures price in COMEX. What that means is that there is a lack of liquidity in London at a time when buyers of silver have been demanding delivery. And this has created a crisis. What it does is it drives the spot price above the futures price, giving what is technically known as a backwardation. These backwardations, when they become big enough, prompt a flow of silver bullion from COMEX to London. And there's been much chatter about that actually happening. The extent to which it's happening, we really don't know. But at one stage, the backwardation was around about $3, which is quite a significant figure. So, but that's now declined, and it's come down this morning. It's down to around about 20 cents. So the backwardation is still there, but it's not really a major factor. It's telling us that there is still a supply shortage, but it's not really that great. So how is the supply shortage dealt with apart from plane loads being flown over from New York? The normal way in which this happens is that bullion banks, on behalf of their customers or on behalf of their own book, will go into the market and they will try and borrow the silver off someone else. So that would be done through leasing. And indeed, the lease rate spiked. We saw the lease rate go up to 30, 40%, and there were some reports that it was even going up to over 100%. I can't verify that, but it does indicate that there was a desperate scramble to get hold of silver to deliver. Now, the other way in which you obtain silver is if you're what's called, if let us say you are a major bank and you are an authorized participant of SLB, which is the big ETF, then what you can do is you can borrow shares of ETF from someone else, sell them in the market. Not sell them in the market, but submit them to the trustee in return for silver. In other words, you can cash in amounts like 50,000 shares at a time if you are an authorized participant. But the problem is that you have borrowed the shares of someone else, gone short in effect, and you've got to close that position. So what we are seeing with leases and also taking out short positions in the major ETFs is you're seeing the problem basically being deferred rather than resolved. So what we have now is a temporary reduction in the problem, if you like, but it hasn't really gone away. The problem really arises from two factors. Firstly, industrial demand is still accelerating because of, if you like, the manufacture of photovoltaic cells in particular. There's defense applications and all the rest of it. And there is an element, I think, of psychology as well, insofar as China has pursued a new restrictive rare earths policy. China is also the second largest miner of silver. So is it possible, we ask ourselves, that China will also restrict its exports of silver? This is possible. There are negotiations which are going to happen, I think, in the next week or two in Korea between President Trump and President Xi. And we'll see how those progress. That might have a small bearing on what is going on. But the problem for industrial users of silver is that they've had a wonderful run when silver has been suppressed in terms of price. And now, of course, it's getting more expensive. So are they going to just release silver into the market to help the market, if you like, to provide that liquidity? I think that's unlikely because they do need it for manufacturing purposes. So I think that a lot of the above ground silver stocks, which are vaulted in either London or indeed in the COMEX vaults, that silver I think is pretty much spoken for. There are also two other factors. If you look at the COMEX situation, there's something called stand for delivery. Now, this is basically something that occurs towards the end of an active contract's lifespan. It basically ties that futures contract to the physical price at expiry. But what people have been doing over the last 2 or 3 years is they have been using this as a mechanism to obtain silver when they have been unable to obtain it from elsewhere. Now, the stands for delivery in this year so far have totaled around about 1,200 tons. Now, that's an awful lot of silver. There are silver stocks in the warehouses. It's around about 500 million ounces this morning. But you can see that from the point of view of the possessors of that silver, they've either stood for delivery and not taken delivery of it, or else they're in the hands of banks, particularly bullion banks and their customers, who might want to hang on to it in case they are forced to deliver against short positions. So that you can see there's a potential liquidity problem there, which really very, very few people are really thinking about. But I think the elephant in the room here is the ETF market. ETFs in India. India is a very, very keen buyer of silver. ETFs in India have been suspended. because they can't create shares and turn that into physical silver because there's no physical silver available in the market. So you can see that these ETFs are actually quite a problem. And if you look at the stocks in London, it's reckoned that about 80% of the silver vaulted in London in LBMA vaults is actually owned by ETFs. So it's not available to the market other than to those banks who can sell shares and encash them, not sell them, but remit them for physical silver. So this is, I think, going to be an ongoing problem.
So a reckoning between the paper market and the physical market looks very likely.
Yeah, absolutely. No, I think that's right. And also, I think people are looking at silver with greater and greater interest because they're beginning to understand that gold is actually in a bull market. And even though we've got a sort of pause in the whole situation at the moment, and we don't know how long or how deep that pause is going to be,
recent market conditions have shifted attention firmly toward precious metals, with Peter Schiff emphasizing that current dynamics increasingly point to the potential for substantially higher prices ahead. Silver is seen as having a credible path toward the $100 level as early as next year, supported by a clear change in monetary direction and the return of large-scale liquidity support under revised frameworks. Schiff highlights that once silver moved decisively beyond the long-standing ceiling near $50, it altered its underlying structure, making a prolonged move back to earlier levels less likely. While near-term volatility remains possible, the broader trajectory continues to lean higher as monetary expansion accelerates and policy support stretches further into longer-dated government securities, reinforcing the backdrop for both silver and gold. Looking further out, Peter Schiff points to gold as being positioned for another phase of sustained strength, with the $5,000 to $6,000 range emerging as a realistic objective within a similar time frame. These expectations are based on the continuation of current monetary and fiscal paths, even without the onset of a full-scale currency or sovereign debt crisis. Should pressure intensify in the US dollar or treasury markets, such projections could ultimately prove conservative. Even in a more gradual scenario, persistent inflationary forces, weakening confidence in fiat-based systems, and declining overseas appetite for U.S. debt continue to support a constructive long-term outlook for precious metals.
I think that there's a very reasonable probability that silver prices hit $100 next year. I don't know if it's going to be early or late in the year, but I think it's going to happen. And if it doesn't happen next year, it'll happen, the following year. But I think more likely next year. I mean, we have a lot of volatility, but once we broke above that $50 double top, I think that set a new floor for silver. I doubt silver is going to go even back down to 50. I think that we're headed significantly higher. We're trying to maybe find a new trading range in here before we have another leg up. But I think the catalyst for the recent move was not only the Fed rate cut, but basically what amounts to the return to quantitative easing. Even though the Fed's not admitting it, that's exactly what they're doing. And I think as the Fed is forced to expand that program and buy longer dated maturities, that's going to be an even bigger, more powerful headwind for both gold and silver. Well, it's just going to add more inflation into the economy. I mean, I think the last few times the Fed did quantitative easing, they got a bigger boost to consumer spending and to asset prices. I don't think they're going to have the same type of luck this time. I think that when you're cutting rates and creating more inflation, when your inflation that you already have is well above your so-called 2% target, I don't think the markets are going to react as favorably in the short run this time as they did the last couple of times. I also don't think that you have foreigners, foreign central banks who are willing to, go along with this as far as buying more treasuries and propping up our bond prices and propping up the dollar. So I think that it's going to be a very different reaction. And rather than stimulating the economy, they may end up sedating it because this policy could backfire and cause long-term interest rates to rise, as well as consumer prices, which are already rising. People are already complaining about the affordability crisis. Well, what the Fed is doing is going to worsen that crisis by making things even more unaffordable than they are now. Well, it should be another strong year for gold. I think 5,000 is kind of a, minimal target. Maybe more likely, if you're looking for round numbers, we should get $6,000 gold sometime in 2026. That would obviously go along with $100 silver. I think both of those are reasonable targets. But ultimately, both metals are going a lot higher because I do think that we're going to have a U.S. dollar and a sovereign debt crisis. And obviously, if that crisis hits next year, gold and silver prices can go a lot higher than that. But even if we manage to kick the can down the road throughout all of 2026, I think both metals could easily hit those targets. As I watch Fox News, and 90+% of the people just praise Trump and how great he is and how great the economy is. Yet one guy comes on and says that's not the case. And, he goes ballistic, even though it was like 6 a.m. Who the hell was awake? Especially like on the West Coast, it's 3 a.m. Only in the East Coast. But no, Donald Trump is wide awake in bed in the White House. I assume he was still in bed. And he's watching Fox News. And, probably when I came on, he probably thought, oh, here's another guy that's going to talk about how great the economy is and everything. And he's ready to hear me praise the Trump economy and what a great job he's doing. And then I come out and I talk about how he's not doing a good job on prices and affordability is going to go down. And I guess he kind of lost it. I really got under his skin. But the question remains, am I going to be back on Fox News again? Or did he pull some strings? But if he gets me kicked off of Fox News, that really shows you where he stands on free speech, because, that was a big part of his campaign to allow freedom of speech, because the Democrats were, clamping down on that and trying to punish people for saying things that, weren't supported by their woke agenda, deplatforming people. And he was very much against that. And I agreed and I supported his stance to protect the First Amendment. But somehow, if he doesn't believe that I should be able to say something negative about the economy, that would be very hypocritical of him. But we'll see. Because I don't do that particular show that often, Fox and Friends, but I had done it like a week or two earlier, and it wasn't like they didn't know what I was going to say. They asked for my position even before the segment. That was a day before. And I told them, yeah, I think inflation is getting worse. I think Trump's policies are inflationary. He's not bringing the cost down. But it's crazy, too, that not only did he say that I was wrong about prices going up, he said they're going down. He didn't say they're just going down. He said they're going substantially down. I don't know any prices that are going down, let alone substantially down, other than gas. Yes, oil prices, gas prices have come down. I just don't believe that that's sustainable. I think that that's a temporary relief that we're getting. But the price of just about everything else is going up. I don't know what the president is looking at when he's talking about prices going down. I don't see it. I see everything going up. And I think the public is sharing that experience.
If these pressures continue to build, the next phase is likely to be defined by a sharp tightening between contractual promises and real availability, where pricing is forced to adjust to reflect what can actually be delivered rather than what is traded on paper. As access to material becomes more difficult, volatility would increase and price discovery could shift rapidly, with sudden moves replacing gradual trends. Market participants who rely on rolling positions or short-term fixes may find those tools less effective as confidence in synthetic supply weakens. At the same time, demand would not ease easily, since industrial users cannot simply substitute away from a critical input, and investors tend to increase allocations when monetary trust erodes. This combination could accelerate a repricing phase in which higher levels no longer discourage participation, but instead reinforce the expectation of further gains. Over time, this environment favors a sustained imbalance, where any temporary pullbacks are met with strong buying, raising the question, When physical constraints dominate the narrative, does the market enter a self-reinforcing cycle that reshapes how value is measured? If you found this insight useful, make sure to like, share, and spread this update to others watching the silver story unfold. Your support helps keep these deep dive analyses coming.